Welcome to your commercial-free, uninterrupted investment show, sponsored by the SEC-registered investment firm, Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who has been putting clients' investment needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, hello and welcome to the Smart Investing Show. I'm Brent Wilsey, president of Wilsey Asset Management, and we got a great show planned out today. We're going to be talking about the personal consumption expenditures came out, which is also known as inflation. We'll discuss that. Tesla reported earnings. We're going to run over those numbers for you. Home price affordability, and also too, we'll touch on the debt ceiling. Chase?
Now, as always, you want to call into the show. That's what we're here for. You got a stock you're looking at. You got a company, we like to call them instead of stocks. You know, people correlate the stocks with too risky many times. So we call them companies, equities. We'll take a look at that for you. We still think there's a lot of great opportunities out there when looking at investing. You want to join the show. Phone number is 833-288-0973. Again, 833-288-0973.
And Chase, in the beginning of the show, we always talk about 3 or 4 different subjects. I listed those subjects. These come from our newsletter. We send that newsletter out at 5 o'clock on Friday. If you haven't signed up for the newsletter, go to our website, smartinvesting2000.com. That's smartinvesting2000.com. And right in the top bar, you'll see the newsletter. You can sign up there. But if you get the newsletter and you see something else on there you want to comment on, you can give us a call here on the show as well to talk about that, because these are things that we look at throughout the week that would be important to investors and the economy. So if you get the newsletter and you say, gosh, they didn't cover layoffs and over-hiring, you want to talk about that, we can do that for you. And as always, as Chase said, we do like running over businesses, companies, equities. We're not going to use that dirty word called stocks to run over the fundamentals if it's a buy, sell, or hold for you. But let's start out with the Personal Consumption Expenditures Index, also known as PCE, for December, came in with an annual growth rate of 5%. Now, this is down from November level of 5.5%. Looking at the core PCE, which strips out energy and food, is the indicator. The Fed closely monitors the inflation number, looks even better with an annual growth rate of 4.4%. I've heard people continue to use a CPI and say that inflation is running at more than 3 times the Fed's 2% target.
And that is, again, extremely misleading. Talked about this a lot on the show, is the core PCE is not nearly as high as the CPI. So, again, you look at that, 2 times 3 is 6, not 4.4. So, I think it's a lot, again, fear-mongering. It makes the headlines. Oh, my gosh, we got to crank those interest rates higher, and the Fed's not going to lay off, and inflation's coming down, but it's still way too high. 4.4, really not that bad.
It's really
not good, but not that bad. But I will say, overall, we still have work to do, but it, again, is decelerating at a good rate, and I'm optimistic it will continue to improve as we progress towards the end of 2023. My projection is still that we will see 1, maybe 2 quarter-point hikes from the Fed, and that rate would be maintained through the rest of the year. I do not see any rate cuts this year from the Fed, as I believe the economy will be better than many fear.
And this is why I kind of said in the beginning, so important to understand this information, because you brought it up. People thinking, 2% target, inflation 6%. Well, no, what the Fed's looking at is the 4.4 is the number. So that's only twice as much. And if you're focusing on that 6%, thinking, it's, rates are going to go to 8% and so forth, you're missing the boat and you're going to make bad investment decisions. You might even do something silly like try to time the market and go all to cash. That's not a wise thing to do. And it's been proven here that last year, I know some people did it. You look at the markets today, and we can't tell what we did, but the markets today, they're up. So if you're trying to time it based on that, and then you get left behind, and then like, oh shoot, now I don't know I didn't look today. I think the S&P is up, 6%, 8%, whatever. Now like, okay, it's going to pull back. Oh shoot, now it goes up higher. And then what happens? Then it's up 10%. Well, I better get in now. And then you get in, and then bad news comes out. Oh, shoot, now it dropped 4%. You start playing that game, which is a loser game. So that's why we give you this information, to try to keep your financial emotions, we'll call it, in check.
And the thing I look at as well is that not just the fear of hiking too far, but again, there's a lot of people out there, and we've talked a lot about this, is the belief that there's going to be rate cuts. And I just don't see that happening, because while the economy is slowing down, I don't see it hitting a point where the Fed's going to be like, oh my gosh, we destroyed the economy. Now we need to cut rates, especially in 2023. Perhaps in 2024 we could have a rate cut, maybe. But I just still think there's enough strength in the underlying economy not to need a rate cut. And we need rates to be at a more normalized level, not what we've had for years. You can't have that easy money. That's where you get these huge spike in inflation, which is not good for the economy either. There needs to be kind of what I'll call like a Goldilocks type situation where rates are in a good spot. And I think that rate cuts, I just don't see any need for them this year. Things could change, obviously, but we'll have to see what happens there.
And we'll say it's a possibility at the end of the year, but what would have to happen is the economy would have to slow down to cause a rate cut. And if that doesn't happen, and I don't believe it will either.
Not even slow. It would have to decline, and I think decline substantially.
Substantially.
Because I still think we're going to have a recession.
Yeah.
But I don't think that recession is going to be bad enough to warrant a rate cut.
Right. Well, and technically we already had a recession.
Yeah.
We had
last year.
Yeah. So, but it's not going to be enough. There is still, we talked about all the money in the economy and so forth. So,
and I do think that a recession will be healthy. And the reason for that is you actually saw consumer spending come down in this PCE report. A lot of people, oh my gosh, that's terrible. And I saw some of that make the headlines. I think that is going to be very good. The reason for that is you saw the savings rate start to come back up. We still had a lot of excess savings, and we're going to do a post on this, probably touch on this again, but there were so many excess savings that were built up during COVID. Well, people spent through those. So the savings rate contracted substantially to levels that were historically low. That could be problematic, because now people may have to rely on too much debt. Debt is what derails the economy and the financial situation. If we can get to a more normalized level, well, yeah, people burn through all those excess savings, but now the savings rate has ticked back up to a more normalized level. That means consumer spending came back down, though. That, I think, is a healthy economy and leads to a good runway for the next decade. Rather than, if we keep things really low, spending still really high, people are running on credit cards, running on debt. That's what could take down the economy substantially 2, 3, 4 years from now.
Yeah. So, and these are things you got to look at, and that's why we watch the data. We don't do it and then it's like, okay, close the books and, well, what happened in November? No, we'll stay on top of this for you. We'll look at different things. If things do change, we'll keep you informed on that. Also, too, why you can get the newsletter to help you out as well. Let's move on to Tesla reporting earnings. They reported earnings, and they did very well. This sent the stock up as much as 11% that day in trading. I have been against Tesla for years, not because it's a bad company, but because it was too richly valued. That is now changing. The earnings for Tesla for December 2024 now stand at $5.79 with a price of the stock around $150, which has gone beyond that now. Gives you a forward PE of 25.9.
And that's not great, obviously, but not as terrible as it was in the past. Remember, years ago, it was 1,000, 150. But when the stock was as low as $102, that would have been a forward PE of around 17.6, much more reasonable. I'm not saying that Tesla is a buy. It still has more to drop or needs to see a larger increase in earnings for it to be considered a value. It is getting close. Maybe in a year or two, it could become a buy. And people might think we're crazy in 2 years of saying, Tesla looks good here. What?
Is that Burton Chase saying, buy Tesla? What?
And I think it is funny because, I was talking to a client the other day, and he was asking about, some of these companies and will they ever become a value? And I said, I don't know when it could happen, but, we've bought the Alphabets, we've bought the Apples, we've bought the Microsofts in the past, but when the valuations get too high, it's not a value company anymore. Companies can be a value company and a growth company at the same time, but we just want to make sure they're that value component. That's what we do. And the reason, we missed Tesla. Yeah, right. Years ago. Would I have loved to buy Tesla 10 years ago? Yeah, who wouldn't have? But you can never predict the future. And what Elon Musk has done there, it's quite remarkable. And that is something that you were kind of trying to predict the future, and things could have popped up that changed substantially, and that stock would have been worthless. They would have gone bankrupt. So things had to go perfect for this growth stock, and they did. Right. And congratulations if you did well on it. But I still think at the forward earnings multiple that it's trading at, now back above obviously 30 times future earnings.
Yeah, the stock closed at 177.90 on Friday. Yeah.
It's just too expensive, and the perfection has to continue for Elon Musk and Tesla, and you're betting that it will, and you're betting that they'll continue to grow at 40% a year perhaps on terms of their sales, deliveries, earnings, and at some point that growth will. So I don't know when. Maybe it's this year. Maybe it's next year. I did think it was interesting they didn't provide full guidance for the year. He was kind of, I'm going to say, sly about his wording for the demand.
Mm-hmm. He's a great marketer.
Yeah,
smart guy. And it is the first car company in many years to make it through. I mean, you had DeLorean failed, Studebaker. There's been other ones that failed. His car company, he did pull it out, so you got to give him kudos for that. But you still have to be careful because competition is there, and they do have a 15% profit margin, which is very positive as well, versus about 6.6 for the industry. But there's talk about cutting the prices of cars, more cars coming out in the EV side, so competition is not good, and that's why we won't pay for the stock. Stock was low, like 101, went up to 177, but it still had a high, I think, of well over 400. Yeah. So you're still down a lot. So don't get too excited about the stock now. We're back to saying, nope, we don't like the stock. We think it's a sell. But at 101, with those earnings going forward, that did start to make sense, and it wouldn't be a buy for us quite yet, but I think the PE then was around 14 maybe.
And you could justify it.
Yeah.
Because Tesla is growing.
Yeah.
And again, we're not growth investors. So we understand we miss things. Don't get us wrong. We stick to our philosophy, though, because that helps ensure that we don't buy things that don't fit our build, and all of a sudden they go lower and we can't justify it. But you could justify a company trading at 15, 16, 17 times earnings if they have a nice growth rate. But again, I do worry. People talk, Tesla's, I've talked about this before. It's not a car company. Funny enough, on CNBC the other day, they point out Tesla's sales. They have these bar graphs. I don't know, looked like 90%. Oh, car sales.
Car sales.
It is a car company.
Right.
It's like saying a few years ago, remember Apple had the same situation where Apple made a big miss on their iPhone sales.
Right.
And, well, they're a one-trick pony. That's all they have is the iPhones. And the stock plummeted. I think the same thing's going to happen with Tesla. If they miss on those car sales, it doesn't matter about the batteries and the solar part of their business because it doesn't matter right now in terms of the overall bottom line. It's something that it's a car company. It's subject to that volatility. Another thing that cracked me up, I feel like I'm on a roll this morning, was the fact that I was reading an article and that they had the most models for the EVs, but they were like counting the Model Y and the subsets of the Model Y. I'm like, no,
you can't do that.
You can't do that. And to me, the Model Y and the Model 3 look very similar to one another.
I don't even know the difference of them. Yeah.
And the Model Y is a little bit bigger.
And the other thing, too, is that they talk about sort of technology and their technology. Well, I had the new Escalade, and I was shocked on Friday. Thursday night. I got home from work, turned the car off, and it said, software update. Do this to update the software. Mm-hmm. Like, wow, my Escalade's a technology car as well. So,
and again, so does that mean that the legacy auto manufacturers should be trading at 20 times earnings?
They're software companies.
Yeah, they're software. So there's no discrepancy now because they can send softwares over the airwaves that people are all excited about. They have the self-driving technology that Tesla has. You can argue that Cruise is ahead of Tesla. Right now, obviously, nobody has a pure service across the country, so it's kind of hard, I guess, to battle who is in the lead, who's going to win, because there's going to be puts and takes over time. But they should trade at similar multiples once that growth slows for Tesla.
Right. Chase, a lot of people, real estate, what's going on with it? You got higher interest rates, prices starting to fall. Let's talk about the home price affordability. And even with the recent declines in home prices, there is still a major affordability problem. In fact, looking at an affordability index from the National Association of Realtors, which is known as the NAR, shows we are still out of line with pre-pandemic levels. The index is based on home prices, median family incomes, and mortgage rates. Over the 12 months prior to COVID, the index averaged 162, and the current estimate for January is a level of 106.
The lower the number, means the higher the problem is for affordability. There are a few ways the number could get back to the pre-pandemic level of 162. First, the average mortgage rate would need to fall to about 2.6%.
Not happening.
Next, family incomes would need to increase by about 50%.
Not happening.
And finally, prices for homes would need to fall by about another third. The most likely case is a combination of all three factors, but unfortunately, I don't see rates coming anywhere close to the 2.6% level, nor do I see income spiking close to 50%. Therefore, I do believe there's still more downside for home prices ahead.
You know what was interesting about this is we point out it came from the National Association of Realtors. It's not somebody that's against housing. It's not somebody, they're trying to force housing down. And it's an index. So it tells you, and I think it is going to be a combination of those three. But I do think it's going to be probably, and we will see incomes over time rise. We will see, I think, housing prices fall further. I don't think we'll see rates fall much further. I think they're in a range, we'll call it, I don't know, from 6 to 7% maybe on the mortgages. But what has to happen, the easiest one to fall is going to be the price of homes. I don't think they'll fall by a third, but I think you could see another 10% because of supply-demand issues.
And what could happen as well is it could just take time.
Yeah.
You know, the old saying, time heals all wounds. But what could happen in essence is I think maybe 2024, 2025, you could see mortgage rates maybe closer to 5%. I think they will come back down to that type of level over time. So then you have that kind of pullback. That'll help a little bit with the affordability. It's not going back to, as we said, 2.6, even 3% I don't see, especially on an average. Then also, too, you have the median incomes. You know, maybe over the next 2-3 years, it goes up by 10, 15%, let's say. Mm-hmm. You know, I'm not making a projection on that median income, but just kind of pointing out that could happen. And then the home prices, they do decline, and then they kind of level out. Well, now you're giving more time for the mortgage rates and also to decrease and incomes to increase. That would then help affordability, but that means that home prices don't go up for years.
Right. And again, you brought the key factor, which is time, because it's not going to happen next week or next month. And I've said to many people, I think the good time to buy a home is probably going to be in 2024 if you're trying to get a good price for it. There might be one or two things out there that look pretty good, but based on these factors you just talked about for the National Association of Realtors, I would not be in a hurry to buy a home at this point in time.
No, and you know, the thing I look at too is the supply of the homes. There's new listings. The number of new listings has actually declined year over year, but what's happening is the number of homes on the market is actually kind of stabilizing, because what's happening is homes are staying on the market for longer. People can't sell them as fast. So what's could happen in theory is you're not selling the home as fast, so it's staying on the market. And even though you're not getting as many new listings, there's still more homes that are on the market for sale because they're just not moving because the demand's declined. Another thing too that I've been hearing, and I kind of want to find more information on this, is the Airbnb craze.
Oh yeah,
that has cooled. Yeah. People bought these Airbnbs thinking they could cash flow, like, I don't know, by doing nothing and making $500,000 a month net.
What, $500,000 a month?
I'm just kind of. There are people that during like COVID.
You mean on selling that Airbnb, not just profits off of $500,000 a month?
Depending on, I mean, I've heard of people, depending on how much you put down and what the mortgage rates were, if you use more cash, there were some people that were making a lot of money off that Airbnb.
Not cash flow. Per month. I mean, cash flow per month, because from the rents you would get not.
Yes, cash flow per month from renting out your Airbnb.
Not $500,000 a month though.
No, 500 to 1,000.
500
to 1,000. So not 500,000. 500 to 1,000.
I didn't sleep well last night, so maybe I misunderstood. Okay. But okay,
yeah,
$500 to $1,000 a month cash flow. Okay, now
you know we talk fast too sometimes, so that could have blended into 500,000, and that'd be insane. You must have a very, very, very nice house or something. Right. But that has changed quite a bit. And those people now could potentially not be making those profits. Now, all of a sudden, they could start to be underwater on that Airbnb. They could be having to pay money into it. Yep. They might not have those renters, the people coming, the short-term rentals coming in, and they're just sitting idly on the market. I've heard this is a growing problem. Well, so now that turns into, do you turn it into a long-term rental? Do you just say, well, maybe things will turn around, or you just eat it and sell it?
Right.
And if you eat it and sell it, that could change the supply of the market as well. I that is something that I am keeping an eye on. I saw this guy, kind of interesting. He has a real estate page, and he was talking about this. I'm like, I want to go back in and look at the numbers closer, because if that is a larger problem, I mean, that could spike the supply, and that, again, increase the supply would help with home prices.
And also, too, if people are getting underwater with those where they were making money before, now they got to pay the mortgage plus have their own house and so forth, they might be saying, I got to get rid of this quick. Yeah. And I've also seen more people that bought a new house, haven't sold the old house because a realtor, and realtors sometimes a little bit too optimistic. Oh, don't worry about it. You can sell it in a month. You can sell it very quickly.
7 days.
7 days, yeah. And that's not happening any longer. So now some people are stuck with the new home and the existing home. Like the Airbnb, they might say, I got to get rid of this. I'll lower the price because it's killing me every month. Yeah. So that could bring down prices, but it takes time. It's not going to happen again next week. It's going to happen over time as people say, okay, I now had this house for 3 months, 4 months, 6 months. I got to cut the price.
And the other thing it does, too, is you think about, talking about the supply side of the market, it hurts the demand side of the market. Because if you look at it as an investor, again, you could before make a good amount of money off Airbnb. Well, now you can't. So as an investor, why would I buy a home?
Right.
To try an Airbnb. The market's too saturated. I can't make money off it any longer. Now that demand part of the equation is gone, supply's gone up, demand's gone down. Again, that's a function of supply and demand. Prices go down in that scenario.
Yep. Let's give it the phone number. It's going to open the phone lines now. 833-288-0973. That's 833-288-0973. And as always, get you through for that unbiased, no strings attached, fundamental opinion about what you want to talk about. We still want to talk about the debt ceiling, Chase, because if you have been wondering why the yield and the 10-year Treasury has been dropping, is because they have stopped issuing notes since we hit the limit. We just hit the debt ceiling, but anticipation of hitting that mark put a lot of downward pressure on yield as demand and purchases of the 10-year Treasuries increased in anticipation of the debt ceiling.
And once the limit is increased, then the government can go back to issuing more 10-year Treasuries, and I believe the yield will increase again.
Yeah, and because that will mean higher rates. They'll do that because they got to float more out there, so they got to raise the yield on those. And that's one thing too, that because the 10-year Treasury yields are coming down, I think that's one reason why your riskier investments like your technology, your cryptos are starting to do good because, rates are coming down again. I don't think it's a long-term trend.
I don't think so either. I mean, I don't see how the 10-year Treasury continues to fall. I don't see how we get to under a 3% rate again on the 10-year Treasury. I think it's much more likely it goes back to obviously a 4%, 4.5% even on the 10-year note. Especially the Fed, we know, is doing quantitative tightening. So they're starting to put more bonds onto the market. As you said, that's increasing the supply. And the federal government, once they start issuing 10-year notes again, that'll increase supply even further. And I don't know if people have been following, but we still have a pretty large deficit.
We do. What is that deficit?
I believe it's around like $1 trillion.
$1 trillion?
Right? Yeah. Isn't our deficit right now $1 trillion?
Oh, a deficit. I'm sorry. Yeah, I was saying that I thought you said debt. But
no, our debt's like $31.4 trillion. Right. Our deficit's around $1 trillion. But the thing is, with the deficit, what that means is they need to issue about $1 trillion in debt, and that needs to be bought. Now, it's not going to come out in the form of 10-year notes. They're going to issue different types of treasuries to cover that deficit. But the thing is, that's more supply coming onto the market, which higher supply generally could push prices lower. That means prices are lower, yields go higher, bonds move inversely the bond prices move inversely to the interest rates.
And another problem that the government has too, I just realized that every month debt comes due. Mm-hmm. They've got to pay that debt off. Where's that cash coming from? I think they do have, and they said they're really not in deep trouble, I think, until September, because I think they have money coming in. I mean, obviously April, you have a lot of, your receipts are very high from taxes and so forth, so your cash flow actually increases with the government. So they can last, I believe it was till September.
I thought I saw June.
Was it June?
I think June, and then they might have to take more drastic actions to push them longer.
Yeah. So maybe it's June is step one, and then September, I think September is like, okay, game over. I think what actually happens. But they do have things coming due. They're paying their bills. But you got to remember, too, that they're not issuing new debt, but debt is coming due that they have to use cash to pay off that debt as it matures.
Yeah.
So, but very interesting situation. We'll keep track of that as well for people. And we have said that we said this last week. It's going to happen. They're going to raise the debt ceiling. They've done it 20 times over the last 25 years. It's
22.
22 times. It's not going to be like, oh, it's not going to happen. Oh, we're going to default. We're not going to default. And I don't get too political here, but I just do want to say, like, you can't just have an open checkbook. You should have debt limits. You should have it to where, hey, we did too much spending. We got to cut back. You can't just keep spending at that rate there. It's not the right thing to do.
And this is part of the problem with politics is both Republicans and Democrats don't want to go near Social Security and Medicare because it's not favorable for them.
Right.
Who's going to win an election running on the fact that I am going to cut Social Security? It's not going to be good. But I've said for years now, I don't understand why we just, and you can't do it for people that are like 2-3 years out from retirement, but people in their 50s. Why don't we change the retirement age on Social Security and Medicare? That was built years ago. Why don't we put in an age adjustment based off life expectancy? That way we don't have to make major catastrophic changes to it maybe 5 years from now. That's the path we're on, where we're just running through money and burning cash flow. If we were to actually come up with a plan to change the retirement age and the collection age for Medicare and Social Security for people, 3, 4, 5 years from now, that would be a huge benefit. But nobody wants to touch it because it's not politically favorable.
And I do believe there's programs that they could cut on. And also, too, I do believe, I've read this in the past, there's a lot of fraud that goes on with Social Security and Medicare. And I knew someone personally who actually they're on dialysis. And they said, oh, well, you're going to do dialysis at home instead of coming to the center all the time. But you got to go through this training. We have to send you all the equipment. And she did all that. Took about 6 weeks, 2 months. And at the end, after the government paid for all this stuff, the dialysis center said, no, you can't do that. So it's kind of like, and they got paid for both sides. And they're still getting paid because had she gone at home, they wouldn't got paid for it. But they forced her to go through all this. They sent tons of computers and equipment and stuff at home that the government paid for. No, we're not going to release you from our program. There's fraud that goes on in the government because it's so big. No one really controls it. But that's just one example. That's what we need to do. We need like someone that really is on top of things to watch the numbers, so to speak, and cut programs that just don't make any sense. I mean, the bird that is, That
should be a nonprofit.
Yeah.
If somebody wants to start a nonprofit, I'm sure people would support that.
Yeah.
But I still do believe like the Social Security and Medicare is something that needs to be tackled. It's we've increased the RMD age.
Right.
In theory, that should be the same concept, in my opinion, to Social Security and Medicare. I mean, we're increasing this because life expectancy has increased from decades ago. Yeah, we should make an adjustment there. And when we first started it, some people weren't even collecting Social Security, or a lot of people weren't even collecting Social Security. They died before they could really maximize their benefits. Now people collect it for sometimes, 35, close to 40 years.
Right.
I mean, that is a huge drain on the Social Security system. And I don't like Social Security to begin with because I think it's an inefficient use of capital, but it's almost like a necessary evil, in my opinion, for a lot of people that do rely on it. It's a tough thing I balance with, but I think there needs to be changes to it, but nobody wants to touch it because it's not going to be, again, a benefit to their campaign.
What's kind of funny, too, is I was surprised they raised the RMD, the required minimum distribution age. Because one thing I always felt like the government's just waiting for those IRAs to come due so they can start collecting tax. Well, by increasing it from 70 to 72, I mean, now they can wait another 2 years for a lot of people to start withdrawing to pay more taxes. I was surprised they did that. I know there's also something in the program that I think it goes to 73 or 74 in a couple more years.
73, and then it goes to 75, I think, in I want to say a few years from now.
Yeah, so because I know I'm going to wait till the very end before I have to pull mine out. We have a lot of clients that same way. They don't need it, but that's a lost revenue source for the government, which I do say thank you, government, for doing something smart. And it is for the reason that people are living longer, but it means less revenue for them because they've deferred many times. I mean, I started my first 401k and I was like 25. So.
Yeah, I mean, Net, they probably lost on it. I mean, a few years ago, I think it was 2019, 2018, when they passed the First Secure Act, they did make that adjustment to inherited IRAs where you can no longer stretch them, which in theory actually can really hurt people's financial situation because, somebody inherits an IRA in their working years now rather than being able to stretch that out through their own retirement. Now they have to get rid of that money in 10 years. Now, if you're in like a mid to high tax bracket, you're having to pull out all that IRA and almost increasing yourself maybe to the top tax bracket over that 10-year period. It's something that could be a revenue source for the government. I don't think it fully offsets the RMD age increase, but it is something that helped increase revenue, I believe, because now you can't stretch that out. Like if I were to, or inherit your IRA, let's say, I would have to take out in 10 years rather than stretch that out over 60 years perhaps.
Right. And I don't remember the laws. That's why I have our CFP, our financial planner, Harrison Johnson. But I know one thing you used to be able to do was actually I wouldn't put you as a beneficiary, but I'd put your child, be my grandchild. You could stretch it out for many, many years. And I don't know if you can still do that. Can't do that. So
it has to come out in 10 years.
10 years. So they eliminated that completely. Okay.
Yeah. And the nice thing is it's the same rule with the Roth, but in theory, the best thing you can do with the Roth, and again, I'd have to check with our financial planner, is you just wait till year 10 because it's all tax-free anyway, so you got tax-free growth for a 10-year period on an inherited Roth IRA. But on that traditional IRA, if you wait 10 years, all of a sudden you could have like a $2 million IRA, let's say, and that's a $2 million income bill. So there's a lot more planning that needs to occur with the rule to the 10-year change there.
Yeah, too bad. Well, I know Harrison's going to be calling in pretty soon here, so maybe he can answer those questions. If you like what we're talking about, you can get all this information and more on our newsletter. Again, we're talking about other things on the newsletter that went out yesterday, layoffs and over hiring. We also talked about stock-based compensation, the Federal Reserve, declining attention spans. I mean, all these important things that you get for free from our newsletter. Just go to our website, smartinvesting2000.com. That's smartinvesting2000.com. And when you just see it right in the front page, you'll see right in the middle of the screen pretty much, you'll see the newsletter on the top bar right next to the podcast bar. So if you missed the show or missed part of it, or hear it again, you got two things there, newsletter and podcast bar. So phone numbers here. Gosh, slow down on the phones. No one's called in yet. 833-288-0973. That's 833-288-0973. And as always, that'll get you through for your unbiased, no strings attached, fundamental opinion about what you want to talk about. And there is Harrison. So let's go to our financial planner, Harrison Johnson. Good morning, Harrison. How are you doing this morning?
Good morning, guys. I'm doing well. How are you doing?
Well, good. I see today we're talking about shared equity agreements. I don't want to share my equity with anybody. What are we talking about here?
So a shared equity agreement is a way to get money out of your house, similar to a HELOC or a mortgage would. There are companies out here that will give you cash for the equity, but unlike mortgages or HELOCs, you don't have to pay interest. Instead, you have to give these companies a percentage of your appreciation of your property plus the principal of whatever you borrowed when you sell. So the pros of this are, while you borrow this money, you don't have to make any payments on it. And if the property goes down in value, you have to repay less. And since this isn't a standard loan, there's not the same underwriting that you have to go through with a loan. So, for example, if you have $1 million house, you might be able to borrow or get equity of around $170,000, we'll say. And instead of paying interest for that, you have to pay back 50% of whatever the appreciation of that property is at the time of the sale. So here's the problem. You can only access about 15 to 20% of the property value, but the repayment is based on the total property growth, not the amount that you're actually borrowing. So in our example, if a property goes up 10% from $1 million to $1.1 million, and you have to give up half of that growth, or $50,000, you're essentially paying $50,000 in order to borrow $170,000, which is equivalent to an interest rate of like 30%. And since it's not technically interest, you can't deduct it like you can with a mortgage. In addition to that, it's really hard to refinance these things because banks don't want to be a part of it because it kind of messes up the equity that you have in it. So really the only way to get out of something like this is to sell or come up with a huge amount of cash in addition to the principal that you borrowed. So it's almost like leveraged shorting your house. And so I've had people ask about this. I've seen people that have got into these things, and you really want to be aware of what you're signing on to because getting cash with no payments sounds nice, but you really have to understand what you're giving up for that cash that you're getting now.
And Harrison, I do think this is probably a good time to do it. Chase and I were talking earlier about real estate. I just don't think you'll see much appreciation in the next in the years to come. So you're not going to be, from what I think, a lot of sharing of appreciation won't be a lot there. But am I hearing too that you might have to pay this back before you sell the home because that could put you in a cash crunch?
You can. Different companies have different terms, but it's usually a term of like 30 years. So it's just at the time you sell the property or 30 years is when you have to pay it back. And I agree with you, Brent. There might not be a lot of appreciation in the housing market given everything. But again, it's even a tiny bit of appreciation on the house is really large relative to the amount you're borrowing because you're borrowing such a small percentage of the house. So it's really like, even a 1% increase in property value could be, equivalent to a pretty high interest rate.
So a 1% appreciation rate, why would that be a high interest rate?
Because it's on the whole amount of the house where you're not getting.
So if you have $1 million home, 1% would be what?
100,000.
10 grand.
10 grand.
Yeah.
1% of a million, 10 grand. But if you only borrowed, let's say $100,000, now you have to pay back $10,000 to borrow that 100, which is like a 10% interest rate, even though your home only went up 1%.
Again, I always come back to the same answer. This is why you need a good financial planner because you really got to work through these numbers.
And that's exactly why these companies work is because you look, okay, I've only got to give up a percentage of my property growth, but when you look at it, why would I want what I have to pay back be based on the total asset itself and not the cash that I'm actually getting from it? That'd be like you getting a mortgage and, the mortgage payback is based on what the property does, not the dollars that you actually borrow. So any interest you pay should be on the amount you borrow, not the assets that it's collateralized against.
And I see people getting into these and not realizing what they are.
Yeah.
And
yeah, I've got a situation right now where I'm meeting with somebody on Monday, and they did one of these things when their house was like $700,000, and now it's worth like 1.1 million. So they have a huge amount to pay back, and they tried to refinance when interest rates were really low. But then as soon as the bank saw that they had this agreement on there, they dropped the application, said, nope, we don't want anything to do with that. And so now they're stuck with their normal mortgage plus the shared equity agreement on their house, and there's not really an easy way to get out of it. So it's something to be very cautious of. You want to make sure you fully understand how these numbers actually work before you just take cash because you don't have to make payments on it right away.
And it is worse than shorting stocks, in my opinion, because as you said, Harrison, it's on the whole, it's almost like leveraging that.
It's like a leverage.
Right.
Yeah, it's a leverage short. Yeah.
It's something that you're gambling. And I mean, while again we believe housing prices are expensive, why we think they'll go down. Gosh, as you said, it goes up 1%, 2%, 3%, and let's say it goes down 5%, but you don't get out necessarily, and all of a sudden it turns around 10 years from now it is 5% higher. Well, it's like, well, shoot. That's why I would never recommend shorting. And people, if things go down, you make money. Well, yeah, no crap.
Right.
If things go down, you make money off shorting.
No crap.
Yeah, I can't say the other word on radio. But the thing is, you have to, again, get into timing the market, which never works. You're going to make the wrong decisions, especially on a primary residence. That house should not be viewed as a gambling chip. That is just something I would never, ever recommend somebody do.
I mean, it's almost where you would have to do it for a lifetime commitment because to get out of it, it's a problem. To borrow against it sounds like it's a problem. And Harrison, real quick before I let you go, is this good estate planning tool or a bad estate planning tool?
I would say bad because in this case, if you pass and then this asset goes to your kids, they are going to have to sell the property and then give up a substantial chunk of it. I mean, I would say this is like a worse reverse mortgage is kind of the way it is. You're better off doing a reverse mortgage because in that case, you also don't have to make payments, but you at least know what the payback is going to be. It's going to be an interest rate based on the amount that you're borrowing, not, an amount based on the property value, which, could go up, it could go down, but you really don't know. So
here's another.
The only benefit, I guess, from an estate planning perspective is if you have estate tax issues because you're worth a lot of money, it could reduce how much estate tax you pay because you're losing so much of it. But that's generally not a good way to go about it.
So, and I guess the other thing too is that when you do pass, that does come due right away. And if the kids want to keep that house, if they don't have the money to pay that off, it's too bad. You got to sell that house to pay off the partner, we'll call them, in the equity shared agreement.
Yeah, or come up with a huge amount of money in order to pay them off.
Wow.
So, which most people, I think, would have a difficult time doing.
Yeah. Well, very, very interesting. Again, I said I didn't want to share my equity with anybody. I guess I was right on that. It's not. There's probably certain times this is good, but not a lot of times. I think probably more people get into them and regret it later on.
I think it's like insurance. There's a reason they're doing it. I think the companies kind of vet these a little bit, and there's a reason they're doing it. It's to make money, and somebody's got to make money on the deal. And most of the time, I think it's the company doing it makes the money, not the person that is getting the cash from it.
And as I said in the beginning, that's why you need a good financial planner like Harrison Johnson. Harrison, thank you very much.
All right, thanks, guys. We'll talk to you Monday.
Okay, sounds good. Bye-bye. Again, as Harrison Johnson, he's our financial planner. He is a CFP. He is not on a commission basis. He doesn't sell product. He is a fee-based planner. No commission splits there or anything. If you want to give him a call and talk to him directly, you can do that at the office, 858-546-4306. That's 858-546-4306. Or go to that website, smartinvesting2000.com. That's smartinvesting2000.com. And you do get a free consultation with him to talk about how financial planning can help you. And so many different places that people can trip up on.
Oh, yeah. I mean, there's so many things that you don't even think of because, I was talking to a client yesterday and she was looking at doing a 401k loan. I was saying, the 401k loans I hate just to begin with, but, she needed the capital for paying something off. And I was like, well, if you take it from here, and Harrison came up with that idea as well, because if you looked at the tax benefits of doing the distribution from the investment account instead of the 401k, it saved you a lot of money in taxes. And it's so worthwhile because there's things that you don't even think of. You're like, I don't need a financial planner. You could be missing out on thousands, tens of thousands, hundreds of thousands of dollars over the course of your lifetime because of little mistakes that you make that you don't even realize.
And again, you can't know about everything. And that's why we have Harrison. I was talking to a good friend of mine last night at dinner, and I said, you need to go to Harrison because, and I've been managing his money for probably 25 years. I said, I don't know everything about the financial planning side. I said, I focus on investing, which takes a lot of time. Well, I mean, we know a lot about our companies, know a lot about investing, but there's a whole other world out there to put together your financial plan, your estate plan. And that's all Harrison focuses on. He doesn't focus on the investment side. He focuses on all these different ways to do the financial planning. And he doesn't do financial planning to get assets under management. He does financial planning to do financial planning, unique in the industry.
Absolutely.
Yeah.
Or sell annuities.
Exactly. Phone numbers here. Gosh, what a slow day. 8:43, and we've got no phone calls yet. I guess we'll wait until 5 minutes till when we can't take the calls. Phone numbers here, 833-288-0973. That's 833-288-0973. Chase, Chevron did report record profits, doubling it and so forth. They're buying back $75 billion of stock. I thought maybe we'd talk a little bit about Chevron here because the question is Chevron still a buy? Should be getting Chevron. They're going to be beaten up on, they are already. How could you make such big profits? Does the government and these people forget 2 years ago, they were losing money?
Or do they forget that they just have completely demonized this company and demonized oil, and it takes time to produce oil. So why would you invest money in something that the government doesn't want to even have be around by 2035?
Yeah, and it's just, and people just, businesses are in business to make money.
Yeah.
And the way to make money is by offering a product that is worthwhile, that can serve everybody, and the consumer wins, and the company gets paid a profit for doing that. Well, they've done that. They came through with oil at a great time when we needed it, so therefore they got big profits. Good, congratulations to them.
Yeah, and I did look up. I just saw we have Tim calling there. Did you want to go through the numbers for Chevron or?
Yeah. Let's go just real quickly because Tim, can you hold for a couple minutes? We just want to kind of finish our little thing here on Chevron because Chevron, their symbol is CVX. I'm looking here, only 0.8% on the float, so no one's shorting this. 72% institutional owned. The PE ratio is 10.2. That is above the industry at 6.8. Price of sales 1.5, more expensive than the industry at 0.6. Price to book value 2.3 versus 4.9. That's better than the industry. Price of cash flow checks in at 7.5 versus 3.6. And their PEG ratio, pretty good, 0.7 versus 1.7. Now, here is the numbers. I'll make sure that these may not be updated because they just reported. Yeah. I'm not sure if our program updated these or not. But prior to this, the earnings per share were up 116%. The industry up 111%. Sales climbed by 45.9. Not quite as good as the industry at 48.9. They were paying a 3.4% dividend. I believe they also increased the dividend, if I'm not mistaken. The payout ratio then is only 31.7. Looking at the balance sheet here, you got a current ratio of 1.4 versus 1.3. Debt to equity, very good, 0.2 versus 0.4. Net profit margin, 15.1 versus 8.8. And people complain about that profit margin. That's not as high as Apple and some of these other companies, so don't beat them up because they got a 15% profit margin. Return on equity, 21.5 versus 22.3.
Other thing, too, here, current price for Chevron, $179.45. The 52-week high is $189.68, and the low, $128.07. Year-to-date, the stock's actually flat. I do see they were down, 4.4% yesterday. I think there were some issues with the oil and perhaps the energy market that could have taken the stocks lower there. But I do go out to December 2024. I see estimated earnings per share of $14.65, would give us a target sell price of $243.19. Trades at a forward PE of about 12.25. The big thing I look at, though, is earnings are declining. This year, estimated earnings per share for 2023, they're estimated to be down 17.6% from 2022. 2024, they're estimated to decline again of 5.6%. So these could be peak profits for Chevron and the big energy companies, as 2022 is kind of an interesting year. I do, again, think oil prices are going to go back up a little bit, but I think that the peak profits could have happened in 2022.
Yeah, and I don't think I'd probably put a buy in this. I probably was put it on hold. And I know a lot of people know that we started paring back a little bit on our energy companies that we have there. So, all right, let's go out to or down to Mission Valley and speak with Tim. Tim, you're on the Smart Investor with Brent Chase. How can we help you out?
Yeah, hi, guys. Thanks for taking my call.
Sure.
Looking at Intel, and they've taken a real beating in the last few days, and wondering what you're thinking for the future of it.
Intel's a difficult situation. Chase and I talked about this after the conference call and listened to the CEO and so forth. Intel is having like an uphill battle. We'll go over the numbers here for you and talk more about it as we go on. But it's really dependent on the new CEO, the new executive team. Can they do what they're promising to do? And the CEO's laid out some very good initiatives, which seem to be attainable. But it's going to come down to that. Looking at the numbers for Intel, we do see that, and this is surprising, only 1.8% is short. You would think it'd be higher than what that is, but that's not bad at all. Institutional ownership is 64%. The PE ratio now is only 8.7 versus 18.7. Price of sales 1.7 versus 4.5. Price to book value 1.8 versus 286. And then price of cash flow 8.5 versus 13.5. Now we have seen the earnings fall by 33.5% when the industry is up 36.6. Sales declined by 12%. Industry up 10.8. The 5-year estimated growth rate for Intel, based on the analysts, is a negative 25% versus positive 10.2. And this tells me that the analysts, as an average, don't think that they can turn things around. But that is coming from a very high earnings growth rate, so that could change there going forward. They do pay a nice dividend, 5.2%. Only use 44.5% of their earnings to pay that out. There is talk, could that dividend be cut? Well, Jason, I'll talk about that a little bit more. We do see on the balance sheet, current ratio 1.8 versus 2.8. Debt to equity, very good, 0.4 versus 0.6. And they have a net profit margin still pretty good of 19.1 versus 23.3. Chase?
And I will say those were for Q3, not Q4, so we don't have those numbers in yet.
Hopefully I'll have those next week.
Perhaps. Sometimes I know it depends on their filings because that's where they pull it from. So
they want to make sure they get good numbers, not.
But current price here for Intel, $28.16, 52-week high, $52.51, and 52-week lows, $24.59. Now here's the crazy part. Still up 6.5% year to date, even with what I'm going to call an abysmal earnings report for Q4 there. And I think a lot of that is coming from the fact that I believe Intel has just been beaten up so much already that there was so much negativity built into it. And even with the stock price on yesterday, it was down 6.4%. Initially, it was down more than like 10% for some of the morning. I think that there was just so much negativity already built into it that I think a lot of people that already hit Intel already sold the stock. So I think there could perhaps be a floor on the price of Intel because I think it's just already gone so low. It's now smaller than AMD. It's smaller than NVIDIA. It's smaller than all the other kind of major chip companies out there, which is again, could perhaps be a good valuation indicator for the company.
And also, too, I want to point out, too, I just noticed that as well, the S&P year-to-date is up 6%. So as bad as Intel is, they're still ahead of the S&P 500, which is kind of surprising.
Yeah. But looking forward to December 2024 now, we are going out that extra year. Estimated earnings per share, $2.03. We use that to get our 16.6 multiple for our target sell price, gives us a target sell of $33.70. Now, one thing I will point out, the discrepancy between the high and the low, extremely large right now. High, $4.75. Low, just 70 cents in 2024. So there's a wide range there.
And how many analysts was that?
32.
30. That's quite a few. And again, that wide range does concern us because it means that number that you gave maybe not quite as strong. And I have seen, and I don't have my 2024 pulled up. I see 2023, 90 days ago, they're down like 24% their earnings estimate. So those are coming down. So we'll see if they can tighten up. But that is one thing that worries us, those wide ranges.
Yeah, and it's something that's very interesting with Intel. Obviously, they rely heavily on the PC market. And one thing that we looked at that, frankly, we should have been more on top of is the decline in PCs that occurred after COVID was kind of something that we were worried about, but I guess we didn't talk about enough on the show here with these chip companies that are heavily involved in PCs. That's really dented demand. So now Intel, they're going through this heavy investment cycle during a difficult time for the industry. And one thing that I'm going to be very interested on is when AMD and NVIDIA report, because Intel talked about how difficult things were for the industry. Are AMD and NVIDIA still having problems with the industry as well? We do know AMD did likely take some market share from Intel, but overall, did they see the same industry headwinds that Intel saw?
And also, too, Tim, I mean, one thing that we look at, rely a lot on, is the analysts. And we talked about how we probably missed the fact that PC sales are so high. Well, so did 30 analysts because they should have brought their earnings way down. I don't know if they were asleep at the wheel. When we were looking at it, we were saying, well, they got all these other factors as well that's going on, but the PC sales were so big, and now they got this big backup of inventory that they got to work through that. They said, I think it's going to take about 6 months. Yeah. So, Tim, I forgot to ask you, do you own it or looking at buying it?
I own it.
Okay.
I own it, and of course, it's dropped quite a bit in the last 2 years or so, and I would hate to sell it at this point.
Right.
Yeah.
Right now, I would say Intel, I'd like to see more data, especially from the AMDs and NVIDIAs. I would rate Intel a hold at this point. I wouldn't sell it. I wouldn't be accumulating just yet. Obviously, that could change quite quickly over the next week or two, depending on new data that comes out. But Right now, I'd place it at a hold for Intel.
And the other thing, too, that Chase and I are talking about as well, because there's this government program that came out with these billions of dollars. We're still unsure. We have, 5,000 pages, whatever. Is the government actually going to give like Intel a couple $1 billion? Because that could help it a lot, because a lot of their expenses now are in capital expenditures. Well, if you get, we'll say, $2 billion from the government, you won't spend as much on capital expenditures. So we got to see how that works.
And the other thing, too, that analysts really didn't like was the contraction in gross margin. They've been talking about that for years. They said, oh, my gosh, they have a 3 handle, which means they're looking for a 39% gross margin in Q1. Most of the time it's in the 50s. But the problem is Intel has such a high fixed expense base that when sales go down, your expenses don't go down as quickly. So your gross margin contracts. But when sales go back up, your expenses don't go up as quickly, so your gross margin expands. I think Intel could have a bumpy road here perhaps over the next 6 months, but I think it could be a great story over the next 2, 3, 4 years. It's hard to look out to 2024, 2025, but that in theory is when that investment cycle for Intel should slow, and they should have new businesses coming online as well.
Yeah, and I think 2023 is going to be a proving year for Intel.
Yeah.
And I think by January 1 of 2024, I think the story will be told. Can they make it? Did they make it? But you're going to have a rough time, I think, in 2023. And that's why we're saying.
I still think it would be, can they make it? Because 2024, that year, 2025, is when the plans are supposed to be in place. So I can't say, did they make it? But will they make it? I think it'll be more clear in 2024.
Say it, yeah. So, but I wouldn't say get out of it, because I think there's some potential. Percentage-wise, how much does it make up in your portfolio?
2-3%.
Okay. So yeah, I'd be comfortable holding.
And I will say the other thing is they have Mobileye still, and they sent Mobileye out on the stock market, kind of more of a valuation on it. One thing I was thinking about actually this morning is they could leverage that for capital. If Mobileye's done very well.
Oh yeah.
If Mobileye continues to do well, they still own shares in it. To help with capital needs, they could sell some of their shares in Mobileye to cover some of their other costs and create some available cash for the company as well.
And I was surprised. I did not hear them mention. Maybe I missed it.
Very brief.
Very brief. Sorry, I missed it on the conference call. Is what I'm going to say. I didn't hear much talk about Mobileye, but you said very brief that they.
And Mobileye, I believe, has their own conference call now as well.
Yeah, and I think they floated, 20% of their...
I think they still own somewhere around 75, 85% of it, 75, 90%. No, it's a pretty large range, but they still own a good amount of Mobileye there, a large majority of it, I should say. Yeah, so they could use that, again, as capital. If they need capital infusion, they have that out there now. Because Mobileye has a market cap right now of about $28.7 billion. I think initially it was $15 billion is when they got that initial bid on the stock market.
And that's only in the 20%, we'll call it 25% of stock they floated out there. So they hold the other, we'll call it 80%, make it easy. So you put a market cap on that in the company. Gosh.
That means their other assets in Intel are very low.
Right. Because actually I think their market cap, I didn't see it there, I think it's about $115 billion. So with Mobileye could be more than half of that.
All right.
Yeah. So it's an interesting story, and that's why I would not jump out of it. I think it's worth holding on to.
Yeah.
Yeah. Okay.
All right, Tim.
All right, guys. Hey, thanks so much. Really appreciate it.
All right. Thanks for calling.
Okay,
Bye-bye.
Take care.
Kind of a long explanation for that, but it is a complicated situation that you kind of have to kind of look at deeply. And that's what we tell people. Before we buy a company, it's 10, 15, 20 hours of research. There's so many things to look at. And even when you own a company, when those conference calls come out, you've got to really dig into them and look at the numbers and what are they saying? What's really going on? Because if you don't do that, you're going to be blindsided down the road.
Yeah. I mean, it's so important to look at the numbers, and there's things that, especially from an accounting perspective, that you have to understand how it impacts earnings, how it impacts cash flow, how it's going to impact as well this year's earnings versus next year's earnings, because that could be a big difference.
Yep. Well, there's a closing bell. So thank you for listening to Smart Investing Show. It is for informational purposes only and should not be used as investment advice. If you'd like to discuss in more detail your investment needs or have other investment questions, feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-546-4306. That's 858-546-4306. And be sure to visit our website, smartinvesting2000.com. That's smartinvesting2000.com. A lot of great information there, like the newsletter, podcasts, and so forth. And for more daily educational information on investment tips, go to our Facebook page, Smart Investing with Brent and Chase Wilsey. Have a great day. Thanks for listening to the show, and we'll talk to you more next time on the Smart Investing Show.
Truth